In today's video, we're going to talk about 5 factors that will shape your Roth conversion strategy. Now, this is not an all-encompassing list, but these are 5 factors that we frequently come across and frequently see mistakes around. Through some of the examples in this video, we hope to help avoid some of these common mistakes. Now, before jumping into each of these 5 factors, I always like to start out Roth conversion videos by reminding you that Roth conversions really come down to the rates that you are going to pay today versus the rates that you avoid down the road. Said simply, if we are paying a lower rate today, like 22%, to avoid a higher rate down the road, like 25%, a Roth conversion makes sense. Whenever I talk about rates, however, I usually get a question around variables outside of tax rates, like a Medicare penalty due to IRMA. To factor in dollarized expenses like this, we want to take this expense and then translate it into a tax rate. For instance, if we owe an extra $1,000 in expenses because we showed $10,000 in extra income, well, we can translate that expense into a 10% marginal rate add-on. We have quite a few videos on our channel exploring this concept. But let's move on to factor number 1, moving in retirement. It's not uncommon for someone to move in retirement, either to be closer to family or to move to a nicer climate. Depending on the tax rate change from one state to another, this can drive some important decisions. For instance, right now we are in some low tax brackets due to the Tax Cuts and Jobs Act. Now, these low rates are set to expire in 2025 if Congress makes no changes. At this time, most brackets are going to rise by 2 to 4%. This opens the door for larger conversions right now. But in our practice, we see many cases where moving in retirement can be a larger variable to consider. For instance, let's take someone that's moving from Michigan to Florida in 2026. They might feel like they should be doing Roth conversions while still in Michigan to take advantage of the Tax Cuts and Jobs Act, these lower rates. But if they converted in Michigan right now, this is what their tax brackets would look like. Now, Michigan has a flat tax of 4.05%. And so this needs to be factored into this conversion situation. Now, depending on this person's situation and the time they have to convert, they might still want to do some smaller conversions while still in Michigan. But once they move to Florida, the impact of leaving Michigan's state tax system is greater than the change in taxes due to the Tax Cuts and Jobs Act. Let's take a look at their tax picture while in Florida. I've copied in the previous tax rates in black down below. And so as you can see, they pay less in taxes by actually waiting and being patient, forgoing converting underneath the Tax Cuts and Jobs Act. This is in large part because Florida doesn't have a state income tax. So if you're moving, make sure you're adequately factoring in the rate change from moving states. Factor number 2, your heirs tax rate. To properly plan for tax savings, we need to be comprehensive. This means thinking about the next generation because taxes don't stop when you pass away. In most cases, you actually shift higher forced withdrawals to the next generation. Now, let me explain what I mean. Here's a tax graph for someone if they live into their 90s. We see that their tax liability steadily rises into the future if this retiree doesn't start fixing tax issues caused by things like required minimum distributions. But what if this couple doesn't live into their 90s? What if instead they pass away much earlier in retirement? Well, by passing on, they will avoid the tax burden on their own life, but instead will be passing a large tax burden to the next generation. This is due to the Secure Act. The Secure Act gives your heirs 10 years to withdraw all of the money from their IRA inheritance. Let's say your kids are high earners in a medical profession, for instance. Well, they may be forced to withdraw 6 figures each year on top of their already high income. This means they can be paying upwards of 30% in taxes quite easily. Now, on the flip side, if your kids are lower earners, it may actually behoove you to pass on money to the next generation. And so this becomes a critical variable that can either lead to larger conversions or smaller, more conservative conversions. Let's take a 62-year-old couple with $1.8 million in tax-deferred accounts. Now, in this situation, their heirs are in lower tax brackets, and we would estimate the tax rate to pass on IRAs to the next generation would be about 15%. Given this, the best Roth conversion strategy actually isn't immediately clear. The graph on the screen shows the tax benefit or the tax loss depending on when this couple would pass away. If this couple lives well into their 80s, we see a significant tax benefit coming from moderately aggressive conversions. And when you talk to many financial planners, this is all the data they will show you. At the end of your life, this is what you should save by doing Roth conversions right now. But what happens if this couple passes away within the first 20 years? Well, in this case, we would actually see tax losses coming from those moderately aggressive conversions. And this makes sense if we think about it. They would be converting at rates of, let's say, 22%, but then if they died, they could pass on that money to the next generation at 15%. And so converting at 22% to save at 15% obviously leads to those tax losses. But what if their heirs are higher earners? And when withdrawing those funds, they'd be withdrawing at a 30% tax rate rather than 15%. Well, now we see a completely different tax picture. Now, both of the top tax strategies start giving this couple a tax benefit right from the get-go. One scenario is very murky as to the best Roth conversion strategy, and the other scenario is very clear. Factor number 3, large taxable account balances. If you've been saving a lot into your brokerage, joint, or taxable accounts, know that this can highly affect how aggressive you should be with Roth conversions. Now, why would this be? The biggest reason comes down to how your income stacks in the eyes of the IRS. Capital gains and dividend income always stacks on top of your other income. So let's say that you have $50,000 of IRA withdrawals and $30,000 of capital gains in a given year. Well, if you're married, that $30,000 of capital gains would be tax-free. The reason being is because it's in the 0% capital gains bracket. But as you fill in that foundation with more IRA withdrawals due to things like RMDs, your capital gains are pushed up higher and taxed at higher rates. You get hit with taxes from multiple angles. I have a scenario like this shown on the left. This couple has a large RMD and a reasonably sized taxable account. Because of this, their dividend income in yellow is being pushed from what otherwise would be taxed at 0% to now being taxed at 18.8%. The reason for this is because that large RMD pushes that dividend income up. And so the reason this ends up being an important factor that can drive your Roth conversion strategy is we are trying to eliminate that added tax on capital gains and dividend income. And so how might this variable of a larger taxable account look inside of a tax analysis? Well, on the left-hand side of the screen, we have a 65-year-old couple with $1.3 million in IRAs and no taxable account. Now, as you can see, this couple sees tax benefits from converting in the 12 and 22% bracket. But if we were to add a $1 million taxable account, even though this wouldn't affect RMDs directly, it would affect the impact from those RMDs. Because of this, we see the couple would benefit from a more aggressive conversion strategy that entailed maxing out the 24% bracket for a few years. As you can see, there's a clear butterfly effect with tax planning. One variable can affect other variables. One variable can change a lot. Factor number 4, Affordable Care Act insurance. Now, I had a discussion with a retiree about 2 weeks ago. Now, they're currently working with another advisor and are on ACA insurance because they're younger than 65. Now, when on ACA, the income you report to the IRS affects just how much you pay for health insurance on a monthly basis. It also affects other variables like out-of-pocket costs and things like that. Now, this retiree knows the importance of Roth conversions for their situation, but also knows that showing a lower income for ACA is also important. Now, how do you make heads or tails of which to prioritize? Well, they went back and asked their current advisor, and their current advisor recommended a $100,000 conversion. Now, without any conversion, this couple would be reporting an income of $85,000. This translated to $189 in monthly premiums. Low income, low healthcare costs. The situation completely changed when we add in a Roth conversion, or the Roth conversion they were recommended. They would now owe over $900 per month for the same exact plan. And this more or less translated to an 8.6% add-on tax rate. Now, because a good portion of this income was converted in the 22% bracket, they paid over 30% in total expenses on that $100,000 conversion. This was well over the rate they should have been willing to pay for their situation. And this just goes to show the importance of factoring in other expenses in that Roth conversion calculation, as I described on the front end of this video. Lastly, factor number 5 is pension income or annuity income. We'll take a look at someone with reasonable Social Security benefits and no pension first. Now, they won't be on Social Security until after 2025. So we will look at future tax brackets for their situation. This entails having some inflated Social Security benefits due to inflation adjustments. Now, once someone is on Social Security, the 10% and 15% brackets really no longer exist, at least for their situation. This is because of how Social Security is taxed. The more taxable income you have, the more you'll start to see your Social Security benefit become taxed. This means that showing $1 extra worth of income creates an extra portion of your Social Security benefit that is taxed and creates a double taxation effect that we show in the purple shaded area on the graph. And we can see that this inflates their marginal tax rate. Now, without any pension income, this couple can reasonably take around $30,000 worth of IRA income without seeing their tax rates rise above 20%. With no pension, our goal would be to prudently convert down to the point that we can withdraw about $30,000 per year over the long term. What if this couple happened to have $30,000 in pension or annuity income? Well, those lower tax rate zones are now being filled by that guaranteed income. Any IRA withdrawal from here means that rates will rise well above 25%. Now, the thing about Social Security taxation zones is that they only last for a finite period of time, basically until your Social Security benefit is fully taxed. Then you would go back to those normal tax rates, which in this case would be 25%. And so the added question would be, if we see this situation, why not convert right through that Social Security taxation zone and fill up all the way to the next point so that we're spreading those raises in our marginal tax rate across a zone that then should lower the overall tax rate we are paying over time. And certainly this is something that you'd want to do in order to spread out tax liabilities. But even if this retiree took out enough IRA income at this point to try to smooth out the added tax of this phase-in zone, they would still see their marginal rate over this $120,000 of income rise to nearly 27%. And so because the increase was so large, that spreading out still leaves a fairly high tax rate. And if they went further than this, maxing out the 25% bracket and moving to the 28%, well, then they'd hit IRMA and see another tax rate increase due to that added expense. This means that this couple should probably doing a lot of heavy lifting right now. They probably want to eliminate as much IRA balance as possible right now, as long as they're paying less than 27% in taxes. The guaranteed income eliminates a lot of the options that they have later in retirement. And so pension income really shapes their Roth conversion strategy. And so there you have it, 5 factors that, if they apply to you, can greatly shape and drive decisions within your overall tax strategy in one direction or another. Now, we barely scratched the surface on variables relating to conversions in this video. If you're looking to learn more, here's a video where I answer 13 common Roth conversion questions to improve your tax strategy. Again, click here to learn more. And always remember, you don't need more money, you need a better plan. Thanks for watching. We'll see you in the next video.